unfortunately, for the first 5 days, we were negative 0.13%. I mean, almost made it. Just if the market had been open another hour, probably would have been able to make it. Here's what you need to know before the bell this morning. Yesterday, we missed it by that much. We noted yesterday that the markets were negative for the first 4 days of the year. And yesterday, of course, was the fifth day of January, fifth trading day of January. Now, it was technically January the 8th, but it was the fifth day of January. And we said that the market would have to have an exceptionally strong rally if it was going to create a positive rate of return for the first 5 days. And man, the market tried. We had a very big advance yesterday in the markets. All of a sudden, all that selling pressure that we saw coming in, particularly into the tech stocks, right? We saw Apple and Microsoft and Nvidia under pressure in the first few days of this year. And we had mentioned that that pressure was most likely being caused by tax gain selling by these professional managers. So, portfolio managers, et cetera, they do their tax loss selling going into year end. So they get the tax deduction for that. And then they wait until January to make all their sales of gains. So they were very overweight tech stocks from the rally last year. So they were selling those stocks to take the gain now because now they don't have to pay any taxes on those gains until 2025. So again, that was that initial pressure. Well, yesterday we saw that rally come back and the buying come back into those very specific stocks. Yesterday was pretty much predominantly Apple, Microsoft, Google, Amazon, etc. Big day. Nvidia, AMD both up over 5% yesterday. So again, just a very big day, but unfortunately, for the first 5 days, we were negative 0.13%. I mean, almost made it. Just if the market had been open another hour, probably would have been able to make it. So very, very close. What does that mean for the year, of course? Well, technically, if your first 5 days are negative, well, that typically leads more times than not to a weak month of January, which tends to lead to not necessarily a negative return for the year, but for lower returns for the year. So in other words, instead of the market generating out an 8 or 9 or 10% average rate of return, it typically tends to be lower, like sub 5%. For the year, actually closer to zero for the year. So again, as we continue to kind of look forward to the year, again, these are all statistical anomalies. We're about to have the Super Bowl, so we'll have the Super Bowl indicator to deal with. Don't put a whole lot of weight into these things because, again, anything can happen. But statistically speaking, again, we go back and look at previous history, right? And when we see the first 5 days of January negative, the year tends to be weaker. If the entire month is negative, then the year tends to be weaker. So again, this is kind of setting the tone. Now, we're only about 1% away from all-time highs in the market. So again, just because the first 5 days of January are negative doesn't mean this market can't turn around here. We were getting fairly oversold. We mentioned yesterday because we're getting oversold, we could get a rally. That's what happened. We're now starting to move that up into more overbought territory. Again, still in a sell signal. Futures are weaker this morning. So again, we'll just see how this plays out. We'll report more on it tomorrow for you. But just continue to kind of just keep investments status quo for now. But that's what you need to know before the bell this morning.